Now the next topic is interpretation of accounts. So last class we have done cash flow statement. Now once the financial statements are prepared, now the financial statements, um, from the financial statement, some analysis can be drawn. So what is the performance of the business during the year, which is presented in the financial statements? So what is that performance should be analyzed, and analysis and interpretation is what is the next step. The definition of accounting also says that the art of recording, classifying, summarizing monetary transactions. Why is this done? So that the transactions can be analyzed and interpreted. The accounts can be analyzed and interpreted. There are many tools available with which the financial statements can be analyzed. The interpretation can be done. Among them, we see ratio analysis is the most most popular tool which is used. Ratio analysis, you should learn the ratio analysis, how to analyze the financial statements. See, it is used in the organizations also. See, for a accounting finance student, it is kind of a lifetime thing. It goes with you. Any kind of an analysis of the financial statements, the most common or tool that is used or is ratio analysis. Okay, so how to analyze that with the help of ratio analysis is what we will be covering in today's class. What is a ratio? To talk about ratio is a mathematical expression of two variables. So select any two variables from the financial statements, a multiple elements from the financial statements. Income statement has a big list of items. Then we have the balance sheet also. Assets are there, liabilities are there. From these items of the financial statement, two at a time are selected. One goes into the numerator, one goes into the denominator. So when we try to find out the relationship between these two variables, or when we present the relationship between the variables in a mathematical form, okay, it is a mathematical expression of two variables. That is called as ratio. So now ratios help us to understand whether the business is doing well or not. What are the various aspects of the business that can be understood? So ratios calculated from financial statements help users of financial information to understand and interpret the information presented. See, the day one, class one we started with, there are many users of financial statements. Many of them are interested to know about the about the organization. What is the performance of the organization? Multiple aspects of it. See, the financial statements give the summary of all the transactions that have taken place in the recent year. In the last year. So the summary is given, but that may not be very meaningful to many. Therefore, they are further analyzed. So the tool that is used is ratio analysis, selects variables from the financial statements and then analyzes and interprets that. This analysis is useful to many users so that they can base their decisions on this analysis. Different users may focus upon a range of financial performance and financial position issues. Ratios can be organized or categorized. So now, how are the ratios categorized? Now, there is a difference of opinion. See, however they are presented, almost all of them cover all these ratios roundabout. We would have it as all of them put together, something around 40 ratios are there. You will also learn ratio analysis as part of management accounting. You will touch upon these ratios. See, wherever you have to talk about how the business is doing, what is the performance of the business. See, even at a later stage, also some other paper, also anywhere, any kind of an analysis interpretation is required. So there is a dependence on ratios. Not all of them are considered, but some of the ratios are useful to analyze and interpret the performance of the company. So if you learn, of course, we won't focus so much here in this paper, financial accounting, because this will be done extensively in detail in management accounting later on, also some other papers. Okay. So we will be learning about what are the different types of ratios. What is that? How is that the financial position of the business or the profitability position of the business can be analyzed with the help of ratios? What some of them we will talk about that and then discuss in today's class. See, category wise, see, few authors mention that in their textbooks or the material that they provide, they mention that there are four categories. Some of them mention that there are five categories. See, broadly speaking, the categories are here. It says that first one, it is profitability ratios. In any order we can learn. One is profitability ratios. Second, we see that liquidity ratios. Then these are turnover ratios, use of resources. Turnover ratios are calculated. And to know the financial position, or the long-term solvency of the business, financial position solvency ratios. Some of them they categorize that separately and they have it as a fifth category also. What is the performance of the company in the stock market? That is valuation of ratios. Since valuation ratios reflect the profitability scenario, so others have taken these ratios also and categorized or account or recorded under profitability ratio. Any category doesn't matter. We would be covering about what are the different types of ratios. First one is profitability ratios. So if we talk about profitability ratios, what is the percentage of profit that is earned? For that, the base will be, if there are two sets of profitability ratios that are calculated. One set of profitability ratios are from the income statement. Another set of profitability ratios are calculated from the balance sheet. From the income statement, if we talk about, from the income statement, the base for the income statement is sales. If sales is 100%, any type of profit, whatever is considered, that profit is what percentage? See, when we look at the income statement, just let's quickly look at the income statement. It is just not one profit which is there. We have gross profit, operating profit, net profit. So there are different types of profits which we can calculate from the or take from the income statement. The logic there is, if if sales is the base, if sales is 100%, gross profit is what percentage? So gross profit into 100 by net profit. Or it could be very specific about what is operating profit. If it is operating profit into 100 by sales. Or it could be net profit into 100 by sales. So it is expressed as a percentage of sales. Let's say if they sold sales worth 10 lakhs and profit is 2 lakhs. So what is the percentage of profit? So 2 lakhs by 10 lakhs. So that would be 20%. 20% is the profit margin. Then again, very specifically would want to know about what is each type of profit percentage that is earned. These all profit ratios are calculated from income statement. See, if profit is called sales minus cost is profit. So very specifically, the expenses also can be expressed as a percentage. So then we understand which type of expense incurred is very high. like very specifically find out about what is cost of goods sold percentage on sales or operating expenses percentage of sales. it, Even in detail, like rent is what percentage of sales, salaries is what percentage of sales. So depending on whatever is the purpose for which these ratios are calculated, all the items of the income statement can be expressed as percentage of sales. So it gives a clear picture about at each stage what is the profit percentage, at each stage what is the percentage of cost incurred, was there any excess cost incurred at any stage. If that presentation is there, if that kind of calculations and percentages are calculated, then maybe a focus can be there on cutting down on costs at certain stages and doing something about keeping the cost under control and improvising the profit. Let's say the cost of goods sold, if sales has increased and cost of a goods sold has increased more than proportionately, okay, then in that case they need to focus on how the cost of goods sold can be controlled, how the costs in manufacturing activity factory, how are they to be controlled, or if it is at the operating expenses stage, if the cost incurred is very high, then what measures should be taken to cut down the operating expenses. Likewise, anything which wherever they can focus will be on those things to improvise the profitability percentage. So the entire income statement can be presented or expressed as percentage of sales. That helps in cutting down on the cost, keep the cost under control, improvise on the profitability. The one set of profitability ratios from the income statement. Second set of profitability ratios are calculated from the balance sheet. See, in this case, we see return on capital employed. See, whatever is the variable from the balance sheet, that variable expressed here, see the revenue as a percentage of that variable. How much revenue or how much profit was earned. See, for that, there are few ratios. Like first one is return on capital employed. If there is capital employed or capital invested into the business, capital is used in the business, as against that, how much profit was earned. Logic is capital employed is 100%. So capital employed will be the total capital from all sources. Broad category of sources are, the other day also we've discussed that debt and equity, broadly speaking, these are two different sources of capital. So if this is the total amount of capital invested in the business, as against that, the profit that is earned is what percentage. There is a difference of opinion about what should be considered as profit. Um, Here in this case, when we are calculating, so profit from operations is one way of presenting it. um, EBIT is another thing. See, EBIT is after meeting uh, operating expenses, non-operating adjustments and all. EBIT is the total amount of profit available to all the investors. Out of EBIT, first interest is paid, then we see tax is paid, then preference dividend, then equity dividend. So EBIT is the profit available to all the investors. So now in that particular scenario, whatever is the assumption, it goes with that. So otherwise, if nothing is mentioned, we take EBIT is what percentage. So EBIT into 100 by total capital employed. Total capital is capital that is raised from equity, capital that is raised from long-term liabilities. That's the total capital that is employed. Then we see that if this is ROCE, first one, this is ROCE. ROCE and interchangeably, there are certain other terms also. Another important thing what we have to remember is there is no standardized formulas for ratios. Slight variations are taken up based on how the accountant is assuming, and they are all acceptable. That particular scenario, if it is something, if this is only the available information, go ahead with that and calculate. Precisely what it is or standardized formula of ratio are not available. More or less, everybody comes very close to the concept but certain variations are also taken up, and it all depends on how the accountant is assuming. So two individuals, when they are calculating the ratios, the same ratio, they may come up with a different answer. Of course, it would not be drastically different, but slight difference would be there because of those assumptions. See here, I mentioned that in the numerator it is given as profit from operations. Some of them take this to be as EBIT. Some say that, see, interest and tax are obligations anyway, they have to be met. Therefore, why take EBIT? Go ahead and take what is the profit after interest and tax, profit after tax. So it is a difference of opinion. So on account of that, the difference would be there in the calculated value. It is okay as long as the assumptions are clear as to how they are done. That is fine. In the examination also, see, if two individuals are assuming uh, slightly different opinions, also they would be considered. It is not hard and fast rule that this is only the thing that has to be considered. So it can differ slightly. So one thing what we have looked in here is ROC, return on capital employed. There are other things also which are interchangeably used, like we see that ROA is another one. ROA is return on assets. Another interchangeably used term is called as ROI. These are all more or less they mean the same thing. See, when the capital is raised, what is the purpose of raising this capital? This capital is used to invest into the assets. So capital employed goes into the investment into assets, total assets. So ROA talks about if the total assets are 100%, the profit that is earned is what percentage? Profit earned is EBIT is what percentage, or whatever is the assumption of profit. So what is that one? So profit, or I will put it here EBIT. EBIT is what percentage? That is ROA. Another such similar term is ROI. ROI is return on investment. So what is return on investment? See, the investment amount, capital employed, or the capital that is raised is used as an investment. The terms may differ in different situations. Some express it as capital employed, some express it as investment. Whatever it is, it means the same. Maybe the term is directly given as investment amount. So therefore, we write this as an expression called as return on investment. Maybe in other situations we have the financial statements provided. So out of the financial statements, what's the capital employed is picked out of from the balance sheet. We find out what is capital employed and express it as return on capital employed. So basically, it would be the same. Interchangeably, these terms are used. The term may be asked as ROA, okay, and then we don't have the value of assets, we only have investment. So investment into assets, so interchangeably used terms. So please learn about all these three: ROCE, return on capital employed; ROA, return on assets; ROI, return on investment. So if investment is 100%, the profit or EBIT is what percentage? See, on one note, we have all these three things which sound, which convey the more or less the same meaning. And what is the percentage? Very specifically, with one type of capital, there is one return or the profit ratio that is calculated. We call it as ROE, return on equity. The return on equity is equal to. So equity is a broader term, umbrella term, under which we have preference capital, we have equity, ordinary equity capital, then share capital, share premium, all kinds of profits that are set aside, undistributed, P&L account, retained earnings, all of them are part of equity. So ROE talks about the profit after tax divided by Profit after tax is the profit available to all the equity holders, both the preference shareholders as well as the ordinary equity shareholders. So the equation would be profit after tax divided by shareholders equity. If equity is 100%, profit after tax is what percentage? So that's how this is calculated. Some situations we very specifically see that it is written on common equity, ordinary equity shareholders. How much is the return available to ordinary equity shareholders? That later on we also see that earnings per share is calculated. So if that is the case, net income available to ordinary equity shareholders divided by ordinary equity capital. So these are profitability ratios calculated from the balance sheet. One set of ratios are from the income statement, one set of ratios are from the balance sheet. Apart from these things, the stock market valuation ratios, if at all, if there are anything, they are also considered under this category called as profitability ratios. Some of them separate them as a separate category, write it as market valuation shares or market or just valuation shares. We will also discuss that as we move forward. Is this clear? Profitability ratios?
It is, ma'am.
Yes. Return on total assets, that is profits from operations by total assets. Then, what is earnings per share? Earnings per share is what's the earnings available to? Earnings per share is very specifically with respect to ordinary equity shareholders. See, out of the list of these items, this is the amount of profit that is available to ordinary equity shareholders. All expenses that are deducted, after deducting that, this is the amount of profit available to ordinary equity shareholders. Done. If this is the total profit available to all of them, per share, how much is that? That is the meaning of earnings per share. Each share, how much profit? Each share, how much profit is available? That's the meaning of earnings per share. Earnings per share is the total profit that is available to ordinary equity shareholders divided by the number of shares. So it gives us profit per share, earnings per share. Earnings per share is net income available to ordinary equity shareholders divided by total number of ordinary shares. Okay. I already explained expenses ratio. Okay. Then certain other things also would be calculated. Earnings per the way earnings per share is calculated. Dividends per share also can be calculated. Not all the earnings that are available are distributed to shareholders. Only a part of it, most of the time, only a part of the profits are distributed to the shareholders. So how much is distributed? So that is DPS. We call it as dividends per share. So when there is earnings per share or when there are earnings available, earnings are made or profits are earned by the company, there is a reflection of this earnings per share in the stock market. Okay, so there are ratios like price earnings ratio, P by E ratio. Earnings per share is called as EPS. So there is a ratio called as price earnings ratio. It talks about what happens in the stock market because of EPS. What is EPS? EPS is earnings per share. How much earnings are available for each shareholder? See, P by E. E is EPS. P goes to the numerator. P is market price per share. So what's the price that is prevailing in the market? If the company is doing well, automatically we see that the reflection would be there in the stock market. So the market price of the share changes. It increases or it improves, resulting in a capital gain for the investor. So set of ratios which are associated with the stock market, like price earnings ratio, earnings yield ratio, dividend yield ratio, to understand about what's the dividend payout ratio proportionately if earnings are available, out of that how much was paid as dividend to the shareholders, DPS by EPS, that is dividend payout ratio. So certain ratios to understand what is happening with this profits available and in the stock market. So that kind of an analysis is taken up as part of market valuation ratios. So selecting two variables from the financial statements and present that in the form of a ratio, any value that is calculated conveys some meaning. So out of that, some interpretation can be done. Those are profitability ratios. Many are there. So each one of them, okay, gives a better picture of how the company is doing in terms of its profitability. Second category is liquidity ratios. Liquidity position talks about how the company is doing in the short run. See, immediate future. So in the short run or the next period, if we talk about how is the position of the business in the short run. Short run, what is required, that they carry on with the business without having any negative impact. Their reputation is not affected. They have good relationship with all their stakeholders. That is all what is the criteria. So the immediate requirement in the short run is about making their payments promptly. The payments are made promptly to the creditors. If they can make that, see, if that is the case, then their activities will be extended into future. See, the relationship with the creditors will be very smooth, and then they can do well even in the long run. If they fail to make the payment in the short run, that will have a negative impact, and then their long term positions also, they would get affected. So it is very important to ensure that the payments are promptly made by the business. So their short run position is very good. But why are we giving so much of importance? Anyone would make the payments promptly. The thing is, see, cash is not kept idle, because cash kept idle does not give any returns. So usually cash is not kept idle. They are not available in the business as cash in hand, or not big amounts of bank balances are maintained, because banks also do not pay much returns. Therefore these cash balances are invested into assets, because only by investing into assets they can earn a return on that. See, that's the main purpose. When the business is carried on, the purpose is to earn a return. How well can they earn the return is by investing amounts into their activities, operating activities, or long term investment activities. Cash is invested. See, on one hand, to earn a return, cash is invested, but yet again, it is also important that cash is available to make the payments promptly. So now in this case, investment should be in such a way that some of the assets mature when they require the payments to be made on the date when the payment has to be made. So some of the assets, they get liquidated into cash, or they get converted into cash. Cash comes into the business. With the cash, they are able to make the payment. If that part of it is taken care of, it they would have available cash as much as it is required. They would have cash available so that the payments can be made promptly. If they make the payments promptly, okay, the relationship with the stakeholders will be very good. Otherwise, the reputation of the business gets affected. Okay, when the reputation of the business gets affected, okay, then it can also result in eventually they going towards bankruptcy, because once the reputation gets affected, all the stakeholders also, they start withdrawing themselves from the company. Maybe the financial institutions, banks refuse to extend any amount of loans because of their default, because of they not making the payment promptly. Further finances may become very difficult to be raised. That is one serious issue. If that is the case, other stakeholders also may start withdrawing. Suppliers may not provide material, or credit facilities may not be given to them. So the operating activity also gets affected. Eventually, it can result in loss to the extent that bankruptcy is also possible. Therefore, to now it is very important to ensure that the short term position of the business is very good. For that, there are few ratios that are calculated, highlight how the business is doing in the short run. One among them is the most important one, what we call it as current ratio. Current ratio is equal to current assets by current liabilities. What are current assets? Earlier also I did mention to you. Current assets are those assets which get converted into cash in a period of 1 year or operating cycle, whichever is longer. Current liabilities are those liabilities which are to be discharged in a period of 1 year or operating cycle, whichever is longer. So when these current assets, the sum total of current assets and the sum total of current liabilities, when they are compared, when they are expressed in the form of a ratio, ideal ratio is current assets should be double the amount of current liabilities. 2:1 is considered to be as an ideal ratio. In certain cases, if they are not into manufacturing business, as much as 1:1 is also, like if it is a service business, they do not invest anything into the operating cycle. We know what is operating cycle. Cash is invested into raw material get converted into finished goods are sold on credit basis, which is accounts receivable. At the end of the credit period, accounts receivable from the customers, cash is received. So that's an operating cycle what we talk about. So when the amounts are invested into operating cycle, okay, um, cash is blocked for some time. But if they do not have that manufacturing activity, operating cycle would not be there. So therefore, in that situation, if they are into, like, for example, if they are into services business, okay, um, as much as 1:1 also is considered to be as a good ratio. So when the current assets get converted into cash, use these current assets and discharge their current liabilities. Why 2:1? 2:1, some of the current assets are not very easily converted into cash. See, the operating cycle is cash. Cash goes into raw material. Raw material gets converted to finished goods. Finished goods is converted into accounts receivable. At the end of the credit period, from them cash is collected back. See, material, raw material or any type of material, we don't see that getting converted into cash immediately. It goes through a very long process or time period. Only after that the material gets converted into cash. Stock gets converted into cash. It is a current asset, no doubt about it, but it is not very easy to convert. It takes a longer period of time, maybe within 1 year or operating cycle. So that takes the most amount of time. Major amount of time is with respect to the stock or inventories, which is a non-quick asset. It is not a quick asset. It is not quickly converted. So for that reason, very specifically, what is the quick ratio also is calculated. Excluding inventory, we also have another item which is excluded. Out of the total assets, two items are not easy to be converted into cash. One is inventory, it takes a longer period of time. Second one is prepaid expenses. Prepaid expenses are very difficult to be converted into cash. at the most. I mean, what's the benefit that can be derived is out of that the um, see the benefit out of that can be derived in the future. For example, prepaid rent is there. Accommodation can be used in the future, but technically it may not be possible that they get back the prepaid expenses that were made in the current year. Excluding these two items, all other current assets are called as quick assets. So find out what is the quick ratio. So these ratios talk about their position in the short run. See, do they have sufficient amount of current assets which get converted into cash, out of which the current liabilities are paid? Apart from making the payment to the current liabilities, they also require cash to meet their operating expenses. To run the business, they have to meet certain expenses like rent has to be paid, salary, wages, printing, stationery, etc. So there are certain operating expenses which also have to be met. Therefore, more than the current liabilities, the current assets should be there. So current assets ideally it should be 2:1 or 1:1 in service businesses. So if we say that it is 2:1 is a very good ratio, does it mean to say that a very high ratio like 5:1 is also is excellent? Can we conclude like that? No. So maybe little higher than 2:1 is advisable, but a very high current ratio is not at all advisable. So what does it indicate? Cash was not effectively utilized. The current assets do not give as much return as fixed assets. Fixed assets give higher return. Current assets do not give higher return because they very quickly get converted into cash. They are not invested for longer period of time. So which means that their their investment strategies are not good. It should not be very high current ratio. It should not be low also. Low creates problems in the short run. High, very high indicates that they are not maximizing on their profitability. They are not effectively investing the amounts in the business. Okay, so there are set of um, liquidity ratios in detail. When we talk about, there are set of ratios like, see, what's the total amount of current current assets available, quick assets available. Another category is absolutely in the liquid form. Absolutely in the liquid form is cash in hand, cash at bank, marketable securities. Anytime this can be this is available in the form of cash. So how much such cash is available in the business? Anyway, cash in hand in the cash box, cash at bank is anytime which can be withdrawn. Marketable securities very easy to be sold in the market, converted into cash. It's almost in the form of cash. So how much is that amount? Or see, out of the total current assets, excluding the inventory, if these are the cash balances or current assets which are available, compare it with what is their daily expenditure. So how long, for how many days are they comfortable that this cash balances will meet their daily expenditure? That is another thing called as defensive interval ratio. Likewise, the very intricately multiple aspects of the short run position can be understood by calculating liquidity ratios. Liquidity is the ability to convert current assets into cash, and with the available cash the short run liabilities are discharged. Those are liquidity ratios. Is that clear? Is it clear? The next category is Use of resources, how the resources are used. We have the category called as use of resources, activity ratios, efficiency ratios, turnover ratios. These are all terms used for use of resources. They are also, see, as I mentioned that they are also called as turnover ratios. In general terms, turnover means sales, generally. But turnover also can mean other things in different contexts. So it's not always it is um, sales, but it can also mean something else in certain other situations. The concept of calculating use of resources or turnover ratios, efficiency, activity ratios is that, see, whatever is the investment made into any variable, whether it is giving a result or a benefit, or they are using these resources effectively or not, is possible to be understood. So if it results in an activity, then it is efficiency. Any investment made into anything should increase their sales activity, should increase their revenue. Okay. So some of the ratios that are used, first one we have receivables turnover ratio. Of course, here it is given as a collection period, but first to find out what is the collection period, we need to first calculate what is receivables turnover ratio. Are you able to follow? Please respond. Nobody is responding. I don't know whether I should be continuing or not. See, for this one, first we need to calculate what is receivables turnover ratio. So receivables turnover ratio is, we would have the turnover or the sales in the numerator. See, because of selling the goods on credit basis, so denominator we would have the receivables. Sales divided by receivables gives us receivable turnover ratio. Okay. So once the receivables turnover ratio is calculated, this is a strategy adopted to increase their sales. So goods are sold on credit basis. That's why receivables are there. But then again, how what is the credit period that is extended to them? So how long does it require for them to collect the amount, or how many days of credit period is extended uh, to the customers, that it would be collected from the customers. So trade receivables collection period, average collection period or receivables collection period, number of days of receivable, multiple terms are there. So out of 365 days, see, out of 365 days, what is the receivables turnover ratio? So 365 days divided by, we have the receivables turnover ratio. So receivables turnover is basically sales by receivables. So in the denominator, it has this fraction. So in the fraction, in the denominator, one more fraction is there, that will become, that will go to the numerator as a reverse. So we just see that it is trade receivables by revenue into 365 days. So it would be an idea of after how many days will the amount be collected from the customers after selling the goods on credit basis. That is the receivables collection period. Similarly, payment period. This will be payables turnover ratio should be first calculated. Payables will be with respect to credit purchases. If credit purchases details are not there, we can also go with cost of sales. So this is because of the um, credit purchases that payables arise. So payables divided by cost of sales into 365 days. So how is the activity going on in the business? So that is possible to be known with the help of these turnover ratio. Another turnover ratio is with respect to inventory. So how long is the inventory held in the business? So now whenever inventory is valued at a cost. So cost and sales are not comparable because sales is inclusive of profit margin. So sales divided by inventory, both of them are on two different levels. Therefore, sales is also brought down to the cost value. The cost of sales or cost of goods sold is taken for comparison with the inventory. So cost of sales by inventory is inventory turnover ratio. How long is the inventory held in the business? Stock holding period. How long is the inventory held in the business? Is inventory by cost of sales into 365 days. So that talks about the period that it requires for the inventory to be converted into cash. Okay. Apart from these inventory turnover ratios, any variable can be compared with the sales activity. See, for the total amount of investment made in assets, how much revenue is generated. So we see that asset turnover ratio. Turnover is sales, sales by total assets, sales by fixed assets, sales by current assets, sales by working capital, sales by total capital employed. So name it and then you can compare the sales value with any variable mentioned, whatever is the variable in the ratio that compared to revenue. So revenue divided by that variable talks about the turnover ratio. So basically it indicates how effectively the resources are utilized and revenue is generated. So those are turnover ratios. Turnover ratios are also called as activity ratios or efficiency ratios, are how well the resources are used. By using these resources, how well the revenue is generated. So that talks about the use of resources. The last category is the financial position. See, as we liquidity ratios talk about the short-term position, we also see that there's a long-term position. Long-term position is in the long run, how is the business doing? The long-term position or solvency or capital structure ratios. Broadly speaking, we see that there are two types of long-term liabilities. One is debt, another one is equity. I did also mention about what are the attributes of debt capital, what are the attributes of equity capital. Debt is a costlier, debt is a cheaper form of capital, but is a riskier form of capital. Equity, on the other hand, is costlier capital, but less risky. So proportionately, when we talk about what proportions the amount should be invested into the business, ideally speaking, both of them should be invested in equal proportions. Okay. See, to get the benefit of less cost, debt should be employed in the business. To get the benefit of less risk, equity should be employed. So ideally speaking, so we talk about what is the debt equity ratio, debt by equity. We talk about what is gearing ratio, debt in proportion to the total capital, that is debt capital and equity capital. Or we have debt to total assets, debt divided by total assets. Like we compare debt to total assets, we can also compare equity to total assets. It's called as proprietary ratio. So the way we want to express about the relationship between the debt capital and equity capital can be expressed. So these ratios talk about the long-term solvency. See, are they doing good in the long run? Because long run, see, these liabilities are not discharged in the long run. See, even if debt is discharged also, it takes a longer period of time. Equity is not discharged until the time of winding up of the company. So how secure are they in the long run? Because debt has to be redeemed. It is an obligation that has to be met. So when it is an obligation that has to be met in the long run, um, for the long run, in the long run, um, see, are they maximizing their profit by employing debt capital? Or are they dealing with the risk that is associated with the debt capital? What is it with the equity capital? If more portion of equity employed may have an impact on their profitability, but it will be dealing with the less risk, etc. So the proportion of debt versus equity expressed with the help of different ratios will talk about the gearing position, long-term solvency, or capital structure ratios. Okay, then we see that see coverage ratios sometimes are, some of them talk about it as part of profitability ratios, some of them talk about as part of gearing ratios, some of them also give them as a separate category called as the coverage ratios. What does these ratios mean? Coverage ratios are, see, the EBIT that is earned, profit from operations, EBIT, earnings before interest and tax. See, out of EBIT only the cost of capital is met. That is, interest is paid out of that. See, after tax is paid, preference dividend, equity dividend is also met out of the EBIT. See, EBIT is the profit that is available to meet all types of finance costs. So, EBIT, can it cover the finance cost? That is, what is finance cost? Fixed finance cost. Out of that, interest is the fixed finance cost. So, do they have sufficient profit to cover the interest? It is just not about interest, but beyond interest also there are costs. That is, tax is there, preference dividend is there, equity dividend is there. So over and above that, how much more is the EBIT than the interest expense that has to be met? Okay. So we have interest coverage ratio, we have fixed charges coverage ratio. It's interest is a fixed charge, but apart from interest, we also see that sometimes the installment amount, that is principal amount that has to be paid. We also see that there are certain types of lease agreements, lease payments to be made. These are also fixed amounts that have to be met. So how much profit is available to meet these types of fixed charges? So that talks about fixed charges coverage ratio. So those are coverage ratios. So each category of ratios, each ratio that is calculated, it gives it gives an value, and this value conveys something about the business. Okay, it conveys about how the business is doing. Liquidity ratios talk about what is the position of the business in the short run. Then we talk about gearing ratios or capital structure ratios, talk about what's the position of the business in the long run. Profitability ratios talk about how good the business is in terms of generating profit. The separate set of ratios related to the operating activities and the profits that are earned, which are included in income statement. Another set of ratios are, another set of profitability ratios are taken from the balance sheet to see how much profit is generated because of investment into various variables, that is total assets or the capital employed that is raised and invested, investment amount. So these are different things that are profitability ratios that are calculated. We also have understood about how turnover ratios are calculated. Okay. Then gearing ratio, coverage ratios. So ratios that are calculated talk about what's the financial position of the business. Financial and profitability position of the business. Any doubts? Okay, the last topic what we have is consolidated financial statements. That is the last topic in this paper, consolidated financial statements. So, how the financial statements are consolidated. Nobody is there listening to me in today's class. Anyone listening to me?
Ma'am, I am.
Are you? I've asked so many times.
Yes, sir.
Is it clear? I know as you approach weekend, interest is also lost. Any doubts?
Abhi, just I want to ask you, consolidated financial statement, is it similar to final financial statement?
I don't know. Somehow your voice is coming very low. Maybe you have to increase the volume of the device.
Wait a second now.
Yeah, yeah.
Ma'am, is it okay now?
Yeah, yeah. It's good now.
Ma'am, I just wanted to ask you the consolidated financial statements, is it equal to or in any way similar to the final financial statement where we just get all the data?
No, it is more than that. See, consolidated financial statements is um, see when there is a parent company. See, parent company may have multiple subsidiaries or a subsidiary company. So parent, it is the responsibility of the parent company to consolidate the financial statement. See, individually the subsidiary will exist, will carry on with the activities, the financial positions or the financial statements are prepared by the subsidiary and it would be disclosed. But because there is a parent company who's I mean which how do we know which one is a parent company? If a company has a controlling stake in another company, controlling stake is if the percentage shares are more than 50%, if they hold more than 50% of the shares of another company, then automatically they start having the controlling stake, because along with the shares they also acquire the voting rights. Proportionally voting rights are also received by the ordinary equity shareholders. So when they have the voting rights they also can participate in decision making. So decision making, a major stake would lie with this company which acquires more than 50% of shares of another company. So then that company becomes a parent company. See, activities wise the subsidiary will carry on with the their activities, they prepare their financial statements, they disclose their financial statements. Parent company also will carry on with their activities, they prepare the financial statements for disclosure. But it is mandatory that the parent company has to club these two, consolidate these two financial statements and disclose them. That is about consolidation of financial statement. So the assets of the parent company, assets of the subsidiary company have to be added together. So for that we have certain things which we have to remember. How is the consolidation? How does it take place? What is it with the net assets, goodwill, controlling, the minority interest, multiple small terms are there. Those things have to be remembered. What would be done? We are only talking about having a share of more than 50%. It also indicates that, say, more than 50%, let's say 51% control or stake they have in another company. It means that another 49% still lies with someone else. Okay, they have a majority stake, but there is still a minority stake which is there in the hands of others. multiple investors. So in that case, how do they deal with minority stakeholders? So those provisions are looked into when the consolidation happens. That is all what is consolidation of financial statement. That's the last topic what we have in the syllabus.
Okay, ma'am.
Yeah. Understood the concept of it?
Yes, ma'am, I did.
Yeah. Shall we do it on Monday? Very few students are there.
Ma'am, if it's okay with you, we can.
No. For me, anything is fine. So
And then it's fine for my as a person, sir.
we'll do it now. We'll do it on Monday. I didn't understand.
I'm fine with either.
So we have 2 more days to go. Monday is one day, and then Tuesday. What would you want to do on Tuesday? Solve few questions from the exam kit.
Sure, ma'am, we can do that.
Yeah. Somebody asked for the video recordings, the class recordings. Video, there is no video. Class recordings. Of course, these PPT would be displayed there. I did share with the coordinator. It's there in Google Drive.
Yes, ma'am, I guess we got the Google Drive.
Okay. Please, you can have the access to that. Otherwise, they are there on LMS, but because I think your college details are still not added on LMS, it is taking time. But eventually, these things would be also there on the LMS. Multiple times you can view them. There's no issue with that, and the resources also can be downloaded. Why is the stencil less today? Tomorrow is weekend. I mean, the weekend starts and then mood sets. Okay. See, a group comprises a parent entity and undertakings, usually other entities under its control, which are also called as subsidiaries. What is a parent company? Which has more than 50% of the voting rights in another company. Okay. So now if that is the case, it is mandatory that the parent company consolidates the financial statements. So IAS 27, separate financial statements permit the parent to carry an investment in any subsidiary or associate at a cost. So they have to spend a cost to acquire the shares. That's a whole big area which is focused about how do they acquire. Is it such simple thing that they use their funds available with them and then purchase the shares? They definitely the other topics what we focus as you advance further. See, whenever some company is trying to acquire controlling stake in another company, we also see that um, there is a defense mechanism coming from the subsidiary also. No company surrenders to any company just like that. So there are so many issues that go into that. So as you proceed further later or not at this stage, but some other topics you will be touching upon how the mergers happen or general information also you can focus on. Maybe you can study about the case studies of how the acquisitions, mergers and acquisitions happen. So they spend the cost to acquire the controlling stake in another subsidiary company, okay, or any associate at cost as non-current asset investment. So they are investing in another company. So under the categories of assets, we have it as current assets and non-current assets. But sometimes the classification is also as current assets, investments, and property plant. That is non-current assets, that fixed assets called as property, plant, equipment, and intangibles. Investment is a separate category. So investment into another company at a cost used to calculate goodwill for a subsidiary. So how much are they spending to acquire the controlling stake? Sometimes, see, when they are trying to purchase these shares, so when the other company doesn't cooperate, they do have their own strategies. So in this process, the price of the shares may become expensive. because they do not want a company to take over that. So in this process, if they spend more than what these shares are worth, that excess amount would be calculated as goodwill, because that's the benefit, the excess amount which the parent companies or the takeover, the acquirer company is using. So that would be eventually calculated as goodwill and recorded in their books of accounts. Now, after this controlling stake is acquired, then the parent company has to consolidate the financial statement. Each company will have their financial statements, where we see that there are liabilities here. Then we see there are assets and equity. The assets would be added up together and then shown in the consolidated financial statements of the parent company. So, group financial statements comprise the following. They have a consolidated statement of financial position, which is the balance sheet. Balance sheet would be added together. Then we see that there is a consolidated statement of profit and loss and other comprehensive income. Income statement will be consolidated, statement of cash flow, and statement of changes in equity. All of them are consolidated. At this point of time, you don't have detailed questions about how do we treat that, but this is basically general knowledge about, general awareness about what actually happens in that. Intricately how to do that consultation is not part of this particular paper. Later on, as you proceed further, you learn about financial reporting as part of financial reporting, that is F7. As part of F7, you will learn everything in detail. This is just basic knowledge about consolidated of financial statement. So how are the assets consolidated? How is the liability consolidated? Then equity. See, is it just simply adding these values and showing? No. What treatment goes in the accounting treatment is what you have to actually focus on that. So consolidated statement of financial position, the method that is adopted, we see that working notes 1 talks about establish the group structure, that is the date of acquisition. If they have the parent and the subsidiary, what is the percentage of stake that they have? So that is first, it is ascertained. Establish the group structure. So what percentage of investment they have in the subsidiary? Okay, so establish that, W1. Next, calculate the net assets of the subsidiary. What does it mean by net assets? Net assets are, the meaning of net assets is from the total assets, the total liabilities or the long-term liabilities are deducted. So total assets minus the liabilities towards the outsiders, the long-term liabilities, they are deducted, is net assets, or in other words, it is nothing but equity. Assets minus liabilities is equity. Okay, so working notes 2, find out what are the net assets of the subsidiary. So what's the equity value of the subsidiary? That's working 2. Equity, we know what is the, earlier also we mentioned that equity is an umbrella term under which there are multiple things that come under that. So we have the share capital, then the premium, the revaluation surplus, retained earnings. Okay, any kind of fair value adjustment to land and buildings or anything which is taken up during that period. So all that, any kind of an undistributed profit, reserve, surplus, all of them would be part of the equity category. That's working notes 2. Calculate the net assets of the subsidiary. Calculate the goodwill on acquisition. What does it mean by goodwill on acquisition? See, goodwill is the difference between the fair value of the consideration paid to acquire control of a subsidiary and the fair value of the net assets acquired. See, when they acquire these shares, they may not be available at whatever is the prevailing market value. there are strategies that are taken up by the subsidiary company to see that the takeover or the acquisition does not happen. So sometimes they buy back their own shares, limit the supply of the shares. So only few shares are available. So in that case, those investors who own these shares may not be willing to sell these shares. So in the process of purchasing that, they may end up spending more than what is the prevailing market value. Any value which is higher than the prevailing market value, that which they are paying, will be treated as goodwill. So it's the difference between the fair value of the consideration paid and the fair value of the net assets acquired. So the difference between that would be treated as goodwill. It represents the premium paid over and above the value of the assets in the business and represents factors such as the business reputation. Then we see that IRS 3 business combinations requires that goodwill is capitalized as a non-current asset. So when it is capitalized, it could be appearing in the balance sheet as an asset. So the subsidiary will have one item called as goodwill on the asset side as a non-current asset in the consolidated statement of financial position and is subject to an annual impairment review. Impairment, we didn't learn about the concept of impairment. I'll just explain this and then we'll end the session. The rest of it, we'll do it on Monday. What is the concept of impairment? We did do a concept called as revaluation surplus. Whenever assets market value increases, the assets which are appearing in the books of accounts at their original cost are revalued to adjust to the fair market value. So on that note, there is a gain that is realized, which is called as revaluation surplus. Assets are increased to its market value and there is a revaluation surplus which becomes a part of the equity. When the value increases, there is also a possibility that the value of the assets also can decrease. There is always a possibility that the value decreases. Like because of technological changes, some of the assets may become obsolete or outdated, not maybe they are no longer useful. In that case, the value may decrease. Okay, when the value decreases, the assets that are accounted in the books of accounts, they would not realize the same value as they are recorded in the books of accounts. They may be a drastic decrease in the value of the assets. If they are sold, they may not realize the same value. So that's a loss for the business. So then, if impairment is taken up, if the impairment review is taken up, there is a comparison of what is the written down value in the books of accounts and what is the fair market value. So if the fair market value is drastically very low, the assets are adjusted to the fair market value. On account of that, there is an impairment loss. That impairment loss will be recorded in the income statement because the assets value is reduced in the as compared to the fair market value. So also goodwill is capitalized. It appears in the books of accounts at the difference in the amount that they have spent to acquire the assets and the actual value of the asset. Asset for them now, it is the investment in shares. Okay, this also will go for an impairment review. See, is the goodwill or the reputation of the business still at that, or is there any decrease in the reputation? On review of impairment, if the value of goodwill has reduced, then they would adjust, write off the decreased value of goodwill to the income statement. Okay, that is an impairment review. We have not studied about impairment because that was not part of the syllabus. But FR, when you study, you will study about impairment also. Okay, so the rest of it we will do it on Monday. Many are not there. So step number 1 is establish the group structure. What is the percentage of investment that the parent has in the subsidiary? Find out what is the net assets of the subsidiary. That is, find out what's the value of equity. third one, calculate the goodwill on acquisition. Okay. Then what is non-controlling interest and the other things we will talk about in the next class. Any doubts?
No, ma'am.
Okay. Okay. From Monday onwards, because this will not take much time, maybe a half an hour or 40 minutes it will require for us to do the topic. After that, I will take few questions from the examination kit. Monday and also on Tuesday, we will solve questions from the exam. Okay.
Okay, ma'am.
Sure, ma'am.
Good night.
Good night.